What's up, traders? My name is Austin Silver. You're going to love what you see in today's video. But if you are not trading Forex and you're looking to maybe transition from Forex into futures, like I did about a year ago, I've got two new courses for you that are newer, beefier, more valuable, and are going to make you more profitable. So if you want to check those out, there's a link in the description. Join us on ASFX TV. You get access to our live streams every day, our Discord, and of course, the two new courses, Futures 101 and Futures 2.0. Thank you very much for checking out this video. Enjoy the Forex course, and hopefully we'll see you on ASFX TV very soon. What's up, traders? Welcome to chapter number 2. In this chapter, we're going to focus solely on divergence. We're going to put the A1 aside for a few minutes and talk about what divergence is really telling us in the market. Before we dive into this whole chapter and before we get into the D1 and D2 systems, we need to lay a foundation of understanding when it comes to divergence. And I think the best way for us to get that foundation, to really put it down, is to just go over some of the most common questions I get from beginners and from advanced traders on the topic of divergence. The most common question is always going to be, what is divergence? The way that I want you to understand it for our group, for us going forward, is that it's a disagreement between price action and an indicator. In our case, the indicator is a 21-period RSI. Ours is attached to the TDI. You guys know that already. But for us, please keep in mind that the divergence that we're talking about, the divergence that we're looking for every day, is a disagreement between price action and an indicator. Why is that disagreement important? Well, because price will lie to you. For whatever reason, the indicator will not. And what I mean by that is you've seen it, I'm sure. If you're watching this course, you've been in the markets for a good enough time here where you've probably seen where price will move almost erratically in one direction before then continuing in what seemed like the direction it should have been going. Price will do that, whether it's because of poor liquidity, whether it's because of order grabs, whatever blame you want to put on it, that's fine. We know from the back testing that price will lie, the indicator will not. Another important factor to take in when talking about divergence is that you can use divergence to not only spot the end of a pullback before it continues an overall trend, but you can also use divergence to spot a possible reversal area. Divergence at its ground level is telling us that the market is changing. And it's important to use the word changing because very often you're going to grasp this divergence like most traders do, and you're going to be seeing it more often now after this course than ever before. And what's going to happen is you're going to say, Austin, there's divergence on top. This could reverse off the high. Right, it could, but you have to remember me saying this right now, this far into the course. What are we, about an hour in here? Remember me telling you that divergence does not mean reversal. Divergence means change. That means that the market does not have to fall off that high just because you can spot divergence at the top. It means that that market might be chopping. What it really means is that you probably should be cautious trading long into that divergence on top. Now, we're going to get into that a little bit more with examples as we go deeper, but understand divergence means the market is changing. The most important levels that you have to pay attention for are right in front of your face here. The Asian session high or low, yesterday's high or low, the 50, 200, and 800 EMAs, because we're going to find pullbacks off these levels. And the other important level to keep in mind is ADR max. This is a point, a lot of people get this confused. ADR max means average daily range is maxed out. What that means is if Euro USD's ADR, its average daily range is 65 pips. Today, it's already moved 65 pips. That could be an area where if you find divergence at that ADR max point, we might see a retracement. Since it maxed out its ADR, it might need to pull back in whatever direction it needs to retrace that move within the average daily range. So write these levels down. They're going to come into play when we get into the markups later in chapter 3 and chapter 4. But remember these 4 bullets as your 4 most important, most key levels that you can ever use for identifying divergence. So what is divergence really telling us? If you're in a trade and divergence presents against us, we may need to consider an exit. And what I mean by that is if you're in a trade and divergence presents on top and you're going long, you might want to second guess if you should hold that long trade now that divergence is presenting, because why? What did I just tell you divergence tells us? As soon as you think that, you have to say to yourself, divergence means change. It's important to keep that in mind. So you can use divergence if it's presenting against you to say, hey, you're in the trade, you're up in profit, but divergence is building, maybe you take your exit here. That's a point where maybe we're going to go over this. We go to the higher time frames to see what the true direction of trend is to determine if we should pull the trade or not. But we definitely want to understand that divergence can present against our A1 trade and signal that change is coming. If we're looking to re-enter a trade into divergence, we have to take note of that because it's going to be a less probable trade because divergence is present. It's very important to keep that in mind. So again, using the long example, if you were looking to go long Euro USD and this is your first trade of the day, but you see divergence on top from the previous high set earlier that day, you might want to pull yourself back from taking that position because you know the divergence on top could signal the market is changing and you might not get a retest of that high because the divergence is present. Now, if what I just said is a little bit too deep for you, we're going to go over this in hundreds of markups. So just follow along here with me, stay with me, maybe rewind me. I know I talk fast, but try to keep yourself here as I'm giving you these visual examples. It's really important, like I said already, I'm stressing this a lot, to not assume reversal just because divergence is present. It's a warning flag that change is coming. And you're going to be able to find these divergence signals in trend and counter trend. That's going to be our D1 in trend and our D2 counter trend. Now, here's an example of using divergence on, happens to be Euro USD, to say, let me not go long into this divergence on top because it could prevent me from moving higher because it decreases the probability of the longs working out. So in this example, if you were looking to go long here off the 50 EMA, TDIs in the buy zone, EMAs are in an uptrend, if you were looking to go long here, it would make sense. But if you're really good at analysis, you can see the divergence. If you don't know how I drew these purple lines, we're going to go over that in a second. But you can see divergence, RSI is falling, price action is rising, and that should keep you out because we're going to trust the indicator, not price action. Even as price is rising, making higher highs and higher lows, we know we don't want to go long here because that divergence is present. Even more, look at those pins right to the divergence line with a falling RSI. That falling RSI is what we want to trust. Not necessarily here in this example to trade it short, but to say, hey, this is not a great time to be going long. So just to go back to the previous slide, understand that divergence can be used in a situation like this to tell you, hey, if I'm looking to go long here and it creates divergence and I am long and I'm in profit, that's a time to potentially take that trade because as you can see, it'll fall away from you. And it can also be used to tell you, hey, if you're looking to go long here, because divergence is present earlier in the day, we want to pull off and find a better trade. So let's talk about how we use divergence. Now, there's two ways to identify divergence, bullish and bearish. Before we talk about the bullish and bearish divergence, I'm going to show you that in the next slide. I want you to understand my way of looking at divergence. No one else talks about it this way. I look at it as in trend, which we call our D1 entry. This is divergence that we find at significant levels that tells us when a pullback is done and trend is ready to continue. That's the first way we'll use divergence to find trades. The second way is our counter trend entry, which is the D2. This is divergence that you see at the extremes, and this is telling us that a potential change is about to occur, either chop or a reversal of some degree. It's important to distinguish the differences between these two. Your D1 entries are going to come when the L50 and the EMAs and all the higher time frames agree with the direction of trend. Your D2 is going to be a less probable trade, and it's going to present at a different point in the movement of that market. It's going to present maybe at overbought, or maybe it's going to present at ADR max or at the high of day, off those significant levels, which would then signal a reversal. So to define bullish and bearish divergence a little bit deeper before we break down the D1 and D2 in detail, I want you to use these visual examples to keep maybe like as reference points. Maybe screenshot this and print it out if you need to. Bullish divergence is defined as price action making lower lows and the RSI, the indicator, making higher lows. So here, the RSI is rising, price action is falling. That's a signal to us that the market could be changing. After the big drop the day before, the market could be changing, and it does. It rises, as you can see, into the next day. Now compare that to bearish divergence. This is when price action is making higher highs and the RSI is making lower highs. So just like you see in front of you on EuroCAD, price is moving higher, but the RSI is actually moving lower. And that signals to us that something is going to change. Look at how price just chops its way up and then falls off that high. This is easy to spot when you can identify divergence. People will get caught going long here and because they don't know how to identify divergence. And that's what, after this course, you're never going to do again. You're never going to try to go long here with divergence present. Instead, you're going to either look for shorts on a D2 reversal off the high, right? Or you're going to wait for a better position, a better price to go long in the direction if that's the higher time frame trend. So let me explain that a little bit more. Where do we draw it in an uptrend? I want to explain this a little bit more. Like I just said, with the L50 in the buy zone and the EMAs being long biased, bullish divergence is going to present off an EMA or significant level in the direction of overall trend, which in this situation is up. So that's going to be your bullish divergence, meaning your RSI is rising, price action is falling. You're at a significant level in an overall uptrend. And that's how you know that that's a good position to be looking for longs. And in this situation, you're trusting the RSI direction being bullish, not the price action being bearish. That's what the bullish divergence is. Now, like I just said, this is drawn on the bottom of price action and the bottom of the RSI because you're looking for it to move higher. You're looking for that RSI to show rise, the price action to show drop, and you're going to trust the direction of the RSI with the D1 entry signal I'm going to show you in the next chapter. Like I just said, this is a D1 entry in direction of overall trend. Compare this to bearish divergence, which would present at a significant level, overbought, oversold, maybe maxed out ADR, going counter trend. So if you're in an uptrend, you're going to look for bearish divergence, which means a falling RSI and rising price action. You're going to look for that at the extremes, at the high, at the low. You're going to, just at the high, because you're in an uptrend. You're going to be looking to almost call the top. This is the D2 reversal off the top. Maybe you're looking that way because you see on the higher time frames that it's bearish overall. Maybe on the higher time frames you're at a significant level, and that's why you could justify taking that short entry in reverse. The bearish divergence telling you to take it short in reverse to the uptrend. Now, again, I know I'm throwing a lot of words at you guys. I know I'm talking fast, but I want to get through this. I want you to write it down, and then we can get into the markups in the next chapter. So to review this slide, understand the EMAs and the L50 being in a perfect uptrend. Your bullish divergence would present off a significant level on the bottom. You would draw this on the bottom of the RSI, it'd be rising, and your price action on the bottom with your purple line or whatever color line, that would be falling. Compare that to bearish divergence, which would signal off a significant level that you could be reversing and coming back down lower. A D2 will present at the top of an uptrend, and you can use higher time frames, of course, to then confirm that if you're going to be able to hold that. But from the get-go, understand that that divergence will come off the top, which means that the trend lines will be drawn on the top as well. It'll be drawn on the top of your TDI, and it'll be drawn on the top of your price action. That's your bearish divergence. RSI is falling, price action is rising, coming off the top. Now, how do we draw this? Where do we draw this in a downtrend? L50 in the sell zone, EMAs are short biased. Your bearish divergence is going to present off a significant EMA in the direction, it's going to come down, of that overall trend. This is going to be drawn on the top of the RSI and on top of the price action. This is a D1 entry used to get into the trade in the direction of overall trend. And again, compare this to bullish divergence, which would present at an extreme and off a key level. And this is going to be known as our D2 entry. This is drawn on the bottom of price action and the bottom of the RSI, showing you a rising RSI calling, in theory, air quotes around, calling the bottom of your downtrend. And you're going to be able to do that and call that by using the higher time frames like I'm going to show you in chapter 3. So again, to review this slide, now we're talking about a downtrend. Bearish divergence is going to present on top of the RSI and on top of the price action. Bearish divergence telling you we're moving down, bearish in the direction of the overall trend. In inverse to that, we have the bullish divergence that presents off an extreme, signaling the bottom, using the D2 entry to find the bottom. This is going to be drawn on the bottom of the RSI and the bottom of price actions. That's your D1 and your D2 in a downtrend. So before we get too deep in the D1 and the D2 system, I want to make sure that we understand first how to draw divergence. Up to this point in the chapter, we've discussed what divergence is telling us, where we should be looking for it, and also the differences between bullish and bearish divergence. If you don't understand those up to this point, please go back, rewind, and then come back to this point here. We're now going to talk about reaction point 1, reaction point 2, and how we draw divergence. So the first thing that we're going to do as we move through a couple examples here is just practice drawing it. We're not going to practice labeling it bullish, bearish. Is it D1? Is it D2? Don't worry about that right now. I want you to just get your eyes trained to spotting the divergence. So the first thing we're going to look at to identify and draw this, you're going to find your RSI high or low. In this situation, as price moved higher, the RSI set its high. The reason this sticks out to me as divergent is because price action continued higher twice, but the RSI came lower. So that creates divergence. The first reaction point that we use to label this as divergence is the RSI high. The second reaction point we use to draw divergence is price action high right here. When we have our 2 points set, as we do here, you connect them with purple lines to visually show you the divergence and show you the direction you should be looking to trade. So now quiz real quick. Would this be a D1 or a D2 idea if you were going to short this off the top? Jeopardy theme song playing in the background. It would be a D2 idea. D1 would be to trade in the direction of overall trend since the move was up, since the L50 was moving higher, but here, because the divergence presents on top, you would look at it as a reversal, as a D2 idea. And we're going to go over that. I'm probably giving you too much information in the beginning, but we're going to go over that a lot as we get into chapters 3 and 4. So now here, see if you can find the 2 reaction points. I'll give you 5 seconds. You got them? There you go. So you have your RSI low, and then you have your price action low. Once you have those points matched up, you connect them with a purple line, and that visually will show you which way you should be trading. RSI says we're due for rise. Price action is falling, which is our lie. You want to trade in direction of the indicator. It breaks the 50 EMA, and it continues, as you see, way higher from there. And that move higher is identifiable as a D2 idea here off the bottom. Remember I said you look for that bullish divergence at the bottom of the downtrend to signal the possible reversal. Again, this is going to start to click, I promise, as we get into more and more of the markups. So now here, you can see the divergence building. RSI hit its low, RSI comes low, but not as low, and price action definitely set a new low. So now that price is moving lower and the RSI is technically rising, you would think, maybe this signals change. Maybe this signals chop. Maybe this thing rises. I need to be watching this. I need you to keep in mind that divergence can sometimes take a long time to build. Here's those 2 reaction points I just showed you. Look how long it takes for this divergence to build, really, with the price action falling and the RSI rising. That's why it's building, because it does not break this original RSI low set here. If it did, then the divergence would be broken. But because the RSI over here never breaks the RSI low here, and price action never breaks the trend line, it's building divergence. Once it breaks the 50 EMA here, it ends up coming higher from there, from that point. But the reason I wanted to highlight this, because looking at it here off the 800 EMA, some people would say, Austin, we could get a bounce here and it could buy, and it's a great place to buy it. I would say, what are the higher time frames telling you? Because to see this build for this long tells me that the higher time frames were probably short biased more than long biased, and that's why it took so long to build. But don't get rushed into these trades. Whether it's D1 when we get into chapter 3 or D2, do not get rushed into the trades. Understand that divergence can take a very long time to build, just like you see here. So now we're going to practice identifying divergence on a couple different markups before we go into the next chapter and break down the D1. Here, as you can see on EuroCAD 15-minute chart, L50 is in the sell zone, so you would clearly be short biased. However, the RSI sets its low and price action ends up actually coming lower. That creates a rising RSI and a falling price action. What is that? Divergence. Since it's divergent, we would be careful trying to short here, coming down later into the day. Instead, which would be the D1 idea. Instead, we're going to show you in chapter 4 how to look at this as a D2 and potentially take this bottom as the reversal. The reason that's a D2, I'm going to keep going over this. The reason that the idea to go long here would be D2 is because the 15-minute trend here is clearly short biased. The D2 is the counter trend. The D1 idea would be better if you were trying to trade this short. But here, what the divergence tells me is that we would not look to go short later in the day until that divergence was broken. So the only idea would be to potentially, if you want to, reverse it and take it long if the signal presents. But here for this example, please just understand RSI low, price action low, that creates the difference in divergence. So here, again, RSI has its high, price action had its high of day, price ends up going a little bit higher just about an hour later. The RSI does not go as high, and even that slight divergence signals change, and change comes, and the market falls away after rising all night. So here, that divergence on top might be small. It might only be 4 candles worth of divergence, but if you're understanding that it can mean change is coming, you could go to the higher time frames, see what direction they tell you to trade, and maybe that tells you where this change is really going, which is actually down in the direction here. So again, identifying the RSI high, identifying the price action high, that tells us, because one is rising and one is falling, that tells us that change could come. Now here, this is divergence building over a few days. You see RSI sets its high way high, almost at 80, very, very high. Almost looks like driven by news. And in the following 2 days, price continues higher. But notice how the RSI does not. So it's building this divergence day after day after day. And the important thing to mention here, when we talk about divergence building for multiple days, I wouldn't look to trade it long, because the divergence on top would tell me that I wouldn't want to take an A1 entry long or a D1 entry long here, because it might stop at the divergence. And at the same time, I wouldn't want to take it short, because I know if the higher time frames are long biased, the D2 will just get me stopped out, and I wouldn't want to short this. So for me, when I see divergence building like this, I normally will just go to a different trade. I will find a better pair that doesn't have divergence on top. That way I can find a move in trend. Because if I wanted to buy this off the 50 EMA here, because the L50 is in the buy zone, EMAs are long biased, I wouldn't be able to buy it because the divergence was already set by reaction point 1 and reaction point 2. And it's funny to see the divergence line tested here and here and here even. So it's important to keep in mind, and I said this before, that divergence can take a lot of time to build. So you don't want to be trying to jab at it, call on the top, call on the top, call on the top, when in reality, you're in an overall uptrend and you should have just been long biased the whole time, trying to buy it as low as possible. So keep that in mind when you're identifying divergence, but make sure you're using RSI high and price action high, the first price action high, as your reaction point 1 and 2. Here, another example of EuroCAD. Once price action jabbed higher later in the day, it becomes divergent here. This type of divergence, as the EMAs start to pick up into an uptrend and the L50 starts to move into the buy zone, this type of divergence would tell me to be careful going long, but if it can be broken, then I would be okay to go long. This would not signal to me, hey, you want to sell this off the top, because the EMAs and L50 are clearly long biased, and selling it off the top there would be a less probable trade. So here, price action makes its first high 6 a.m., RSI makes its high for the day, price continues higher, but the RSI comes lower, so you got some divergence even in there, and then price goes higher even again later in the day to make more divergence. As you can see, the RSI does not break for a new high, so that would still be valid for this earlier divergence formation. Here on the bottom of EuroCAD, we're looking at the RSI reaching oversold, price action jabbing down one more time, a little bit lower than previous body, RSI not making a jab lower at all, showing us rise. So with the RSI rising, price action falling, what happens? We know the market can change now. We know something can happen. It might hit the 50 and chop sideways. It might hit the 50 and break and come higher, as it does. It might hit the 50 and even come lower. But for a brief time, you have to be aware that this divergence on the bottom means change. And you don't want to trade into the direction of that change until you know it's broken, that you know that that change does not mean full reversal. This is another what would be D2 idea off the top, because you're identifying divergence on the top in an overall uptrend. EMAs are in an uptrend, L50 is swapping but rising. Here, that falling RSI and rising price action tells you to trust the TDI because it does not lie. And as you can see, it breaks the 50, breaks the 200, and ends up moving lower off the divergence off the top. As soon as that high was set and the RSI did not jab back up to overbought, divergence was building and you know change could come. So it's important to keep that in mind. And again, I'm just using reaction point 1 as my RSI high, reaction point 2 is price action high, and I match those points up. Now here, another example of showing divergence on top to see that D2 reversal. Here, RSI made a high about 5 in the morning. Price action continued higher, even though the RSI did not, into the New York session into 10, 11 o'clock in the morning. So with that price action rising and RSI falling, you know that the market conditions can change. So with the push up, the move being up, knowing that it can change, that means it's either going to chop or fall away. Here, it falls right back to where it came from. Shoots up with that huge push and comes right back down based on that divergence on top. So it's important, again, to not ignore it. You would want to take note of this on top and draw it with these lines as I have, using reaction point 1 on your RSI high, reaction point 2 is your price action high, and you would want to use this to say, okay, it's there. If I'm long, I'm going to look to take profit now, or if I'm looking to go long later in the day, I'm going to wait because there's divergence on top, and I wouldn't want to trade long into a falling RSI. Or the third option of what this tells you is that you could use it as a D2 and take it short. Now, again, a lot of these examples I'm saying it's a D1, it's a D2. We're going to go over exactly where the entry signal is with the D1 and D2 in the next chapter. But for now, I want to keep driving home the point that you should use reaction point 1 and reaction point 2 as your RSI high or low and your price action high or low to draw that divergence. That's what we're going over here. Again, RSI high set about 5 in the morning, but price, as you can see, continues higher. It ends up actually creating a falling RSI into the next day as price continues up. What does that rising price action but falling TDI tell us? It tells us that it can change. Here, the change comes as it consolidates and then falls away. It actually fell lower than where it started its original move up from. So using the divergence on top, we're going to be able to spot D2 reversal entries right here and take this down if you choose to. Another example, NZDJPY. RSI is set at its high, price action goes higher twice, 3 jabs, and it ends up falling back down to the low of day. That change, that fall, that drop, would be qualified as change after the move up to start the day in the Asian session. So it moves up, creates the divergence. That means change is coming. It's either going to chop or move lower, and it ends up coming lower. Now, why did this end up coming up higher into the next day and into the overnight? Well, that's where you would turn to the higher time frames to see that it's in an overall uptrend. So this divergence here on the 15-minute is signaling the short-term pullback back to the 200 EMA before the move in direction of overall trend on the higher time frames. Again, another example on top, RSI sets its high and price continues higher into the next day. That divergence with rising price and falling RSI tells you what? You've heard me say it now 15 times. It tells you change is coming. It's either going to chop from that point or fall away, and it ends up falling away as a D2 idea. Here, another example on NZDJPY. RSI sets its high at the changeover of day, and price chops its way slowly until it finally makes a new high here later in the day around 8 o'clock in the morning. Look at how that RSI is falling. That tells you the direction this thing is going to move. Even with the TDI in the buy zone, what it should signal to you is that change is coming. You would not want to try to go long here after that divergence is set because you know that it could chop and or fall. And that's exactly what this does. It falls, looks like it gets chopped around news, and then continues even lower into the 12 o'clock hour. So it's important, so important, to use divergence on top in an overall uptrend like this, even with that perfect TDI, to say, hey, I'm not going to look to go long in here because I know the divergence can signal change. And if you can get in the habit of doing that, then you're going to get into an even easier habit of taking D2 reversal entries. Here, when you see the potential top set in, you're going to be able to measure risk reward and take these in the opposite direction of trend, EMA to EMA. And we're going to go over that in chapter 4. Here's another example on EuroCAD. Look at the RSI setting its low, price action then coming a little bit lower, but the RSI is rising. With that rising RSI and falling price action, that signals to us, drum roll, change is coming. The change here took this higher instead of just chopping it sideways. Even with a perfect L50 in the sell zone, even with EMAs coming into a downtrend, once this divergence is set, I would never look to go short here during the rest of the day because I know it could use that divergence and be reversing. It could be changing direction completely. Here's another example. This is GBP CHF. You can see the RSI on top sets its high. Price action jabs higher one more time. And that's where we see that divergence that tells us the RSI tells us that it's falling. Even if
price action moves higher and continued higher, we would want to make sure we do not ignore the fact that the RSI was making lower highs as price action made higher highs. Now, when you see all these examples that I'm showing you in this chapter, you're saying, Austin, this looks like a lot of reversal stuff. It's a lot of reversal stuff. In these examples, it is. But if you can identify divergence correctly, you're going to use this same tactics, the same skills that you're using to find reaction point 1, like you do here, and reaction point 2 here on the top. You're going to use that same skill set to identify it on the lower time frames in the direction of trend, on the 1 minute, on the 5 minute, to get those solid D1 entries. So don't look at this as, oh, all these examples, he's showing me divergence on the top, divergence on the bottom. That's not the point. The point here is to show you divergence itself is using 2 reaction points at least to show the falling or rising RSI in opposite direction of what price action is doing. So here again, falling RSI, rising price action, that signals divergence. Here, rising RSI, falling price action, this can lead to the D2 reversal idea. And at the same time, it can say, hey, be careful trying to go short after this divergence is already set. And when it pulled back to the 21 EMA right here, you could look and say, maybe we should short this. Look at the L50, look at the EMAs. I would say, no, you have to draw the divergence like this. Do not ignore from the previous day the RSI low, especially when you see the when you see it continue to kind of chop its way lower without making RSI come down and without making that RSI come and make new lows. So it's really important to never, even if you're not going to trade it, if you're just doing your analysis, you should never ignore divergence, whether it's helping you or it's against you. This is another example of a potential reversal. NZD-JPY, you see the RSI set its high, price action comes a little higher, that creates divergence. That can signal change. What's the change? It reverses its entire day's worth of rise and drops to a new low of day. So here, it's rising, it's rising, it's rising. You would look in here off the 50 EMA for divergence on the lower time frames to trade long. Now here on the 15-minute, when the divergence sets in on top, that tells you that long move from earlier could change. That long move was based on the L50 rising and the EMAs being in a buy zone. But now you have divergence on top that tells you it could change, and it does. It comes lower. So now that we've gone through all of these markups showing you how to draw divergence using reaction point 1 and reaction point 2, you should understand what divergence is, where you should be looking for it, what's it telling us, and how to draw it. So you're probably itching to figure out, how do I turn this into an entry signal, Austin? I want the D1, I want the D2, right? Are you ready for this? So let's break it down a little bit more before we jump into chapter 3. The differences, again, are in trend, D1, counter trend, D2. Write this down, screenshot this, you don't want to forget it. In trend is D1 entries, counter trend is D2. So what's the difference? The in trend trades are going to be off significant levels, whether it's 50 EMA, 200 EMA, yesterday's high, Asia high, something like that. It's going to be off a significant level, and the higher time frames are going to agree with the direction. So you're going to have multiple reasons to take that trade. Now, this is going to be something where you use the L50 and the EMAs to help you dictate the direction of trend. So if you can find a perfect L50 in the buy zone with perfect EMAs that match it, telling you to go long, you're going to use all the significant levels that you know how. Yesterday's high, yesterday's low, or you're going to use the 50 EMA or the 200 EMA. You're going to use those significant levels that I gave you in the earlier parts of this course to look for longs in direction of the overall trend off that significant level. And if you can have higher time frames agree with you, you're going to have a really solid D1 trade that possibly can run for multiple days. Flip this and look at the counter trend. This is going to present at the extremes, the overbought, the oversold, the maxed out ADR, yesterday's high, yesterday's low, and you're looking for it to go full reset, we call it, back to the 800 EMA. So you're trading back in the direction of the EMAs when you're talking about the D2 entry. These should also use the higher time frames to confirm or deny the direction you're trading for that reversal. So for example, if you're looking at a downtrend and you think it might be at a bottom because it's oversold, you would want to go to the higher time frames, the 1 hour, the 4 hour, the daily, and say, hey, are these long biased? Would it make sense for me to buy it off this support level? Because if so, then that D2 reversal idea could make sense because the higher time frames are always going to overpower it. But if they don't, you can then use the higher time frames to pull yourself back and say, I'm going to remember what Austin said, that D2 trades are tougher than D1 trades, they're less probable, and I want to turn my focus somewhere else. So now you should understand very clearly the difference between the D1 and the D2. It's D1 in trend, D2 counter trend. If you have any questions about this chapter, about how to draw divergence, if you have any questions about what it's telling us, what it means, and where to look for it, please drop a comment below or reach out to me via email or Facebook or Telegram, whatever you can do to get a hold of me. I'm very happy to clear that up for you if you have any questions at all. Going forward, I'm not going to backtrack so much on all the basics we just covered, on drawing the divergence, reaction point 1, reaction point 2. I'm not going to touch on that. I'm going to go fast because we need to go through a lot of markups. We have 130 slides in the next chapter of the D1 system alone to go through. So if you're ready, I'm ready. Let's get into the D1.